Welcome to another edition of the Energy Week podcast. Ryan Ray alongside the one and only Dr. Energy herself, Ellen Wald. Ellen, how's it going today?
Everything is fantastic, although I think it's a bit of a slow day for energy.
It's a slow day for energy, but it's not a slow day for political figures such as Michael Avenatti, who, did you see, right before we came on the show, I was checking Twitter, is going down hard for extorting Nike.
I saw a tweet. I was also on Twitter right before it, and I saw a tweet that he says he's going to have some press conference where he's going to expose some huge Nike scandal. And I was like, oh, that sounds kind of interesting. And then, bam, they're prosecuting him for trying to extort Nike. I mean, my God, the guy needs to take a hint.
Yeah, and then over the weekend, I don't know if you saw this or not. It wasn't. Barely made the radar, but the Mueller report dropped. You probably didn't see that. Barely.
I thought I heard something about that, but I got this video of my 20-month-old niece who was saying that the train goes choo-choo, and then she was kind of like dancing around holding this little red toy train, and that just like occupied all of my mental space.
You were probably better served. I'll just say that. I did offer publicly though, for the White House or anyone involved, for $80 million, I will investigate Robert Mueller to see if he conspired with Trump or the Russians. I'll look at it from both angles for $80 million, and I could probably wrap that up next week. So that's my standing offer. Ellen, I'll cut you in if you feel like there's something you can lend your skill set to.
I was contacted by a journalist, I will not say who wanted to know if I thought that now that the Mueller investigation is concluded, if that could mean that Trump will now sign the NOPEC bill. And so I was trying to think if there's sort of any correlation going on there, which I really don't think there is. I think there are pretty strong reasons not to pursue NOPEC legislation. I don't think it's going to go through Congress anyway. It's not going to get to the point where it's going to need to be signed or vetoed, but you never know. And I'm thinking the only thing I could possibly think of, the only connection I could come up with is that, well, Russia is part of this, extra OPEC deal. And so maybe if Trump vetoes this thing now, it could be read as like he's conspiring to help Russia, except that Russia isn't actually cutting its production at all. So they can try to claim that they're part of this OPEC cartel, but ain't really working out. So that's the connection. That's the only connection I could think of.
Well, we will see in short order, I'm sure, now that Trump has spread his wings. And what was the movie? Bad Cops or Other Cops, or Will Ferrell and the Marky Mark, and he had a classic line. I'm a peacock, you got to let me fly. And I always love that line. And so I'm sure Trump will feel like that after his vindication this weekend, or so-called vindication, or whatever it is. A couple things, Ellen, here. I'll send you offline. Baby Piper Ray will be here, unless something happens, April the 3rd. So we should be back this week. Obviously, we're here next week. And then the 8th, we will see. Just depends on how Mama and Baby are doing. But then after that, we should be back to regular scheduled programming. Sorry, last week I was out of the country on a little bit of business. Okay, so we have a question. And you do not know this question. I do know the question. So it's I've had some time to think about it, but it's hitting you fresh here. And the question comes from Will, and it says, with all the new space companies online and launches in the private sector at an all-time high and booming, will the propellants they use be a factor that the API takes into account?
Wow, that's I'd never thought about that, but that is a really interesting idea. I mean, what kind of propellants do these? I'm assuming they use really high octane jet fuel, right?
That's what I would assume as well, yeah.
Yeah, like a really high octane jet fuel. And is that going to have an impact in jet fuel demand? But that's also interesting because if you're thinking about that as a component of jet fuel demand, okay, is it really now? And as we have learned from Dean Foreman, that jet fuel demand is a pretty good indicator of American economic activity. But if these space companies start to take up any kind of component of this jet fuel demand, can we really continue to see jet fuel demand as an indication of America's economy. I mean, obviously, I guess if people are sending stuff into space, that's a good sign for the economy, or satellites going up, whatnot.
Sure.
But it might not be the same type of correlation as if you're assuming that just like commercial airliners are buying jet fuel. I think we should ask the economist himself.
Yeah, that's exactly what I thought, something along those lines. And then I also wondered, even though obviously there are a lot more private satellite companies that are putting up birds in the skies, he's mentioned, I'm not sure how much of the overall supply they're actually tapping into. So it could be a deal where even though they're moving up exponentially, there's still not enough to be on the radar. So that's, I think, as you're saying, there's some indicators to look at. And the other thing is how much of the actual supply and demand market are they actually fiddling with? Because if you remember his answer on the plane, when before the announcement of all the planes being grounded, he kind of acted like, well, unless a lot of them are grounded, it really won't have that big a significant impact. So
and then the next thing we knew, they were all grounded.
They were all grounded. So, but anyway, so a great question from Will. And when Dr. Foreman comes back on, we will ask him that. And I'm actually going to be at an event next week, I think, that he will be at. So I might try to wrangle him in there for a minute or two if I can get a word in with him. So, okay, Ellen, we got a couple articles, and we got Gene Epstein coming on to talk about commodities trading and insider trading. So it should be an interesting conversation. But first, Wall Street Journal: Omani port gives U.S. Navy greater control over strategic waterway near Iran. This, when you talk about international oil and gas, you talk about international U.S. foreign policy, how we have our Navy positioned over there. Seems to be the focus of a lot of debates when we talk about pulling out troops or readjusting things. Is what are you going to do with the Navy? How are you going to protect the Strait of Hormuz? So is there something new in this piece, or is it just that same argument being rehashed?
Well, I think what's interesting is, there's the Strait of Hormuz is clearly, I would say, I mean, other than I guess the Suez Canal, which isn't really in particular conflict right now, but other than the Suez Canal, the Strait of Hormuz is probably the most critical. Well, okay, I think it's definitely one of the most critical waterways for the oil trade. I'd say the other is also the South China Sea. We just don't hear a lot about it, but that's also really, really critical, is the South China Sea. But all right, so Straits of Hormuz, the Suez Canal, and South China Sea, really, really key for the movement of oil in the global market. And why the Straits of Hormuz are so important is because they're basically are largely controlled by Iran, and there's always this kind of slight threat that possibly they could try to close them. And I've always argued that this kind of threat is all posturing, because the U.S. Navy Fifth Fleet is basically right in the Persian Gulf, and there's no way that the Iranians just simply don't have enough naval power to counter that. What the U.S. has. I mean, if you look at just having the aircraft carriers and stuff around there makes the U.S. Navy so much stronger than what Iran has. So I've never really seen this as a serious threat, but it's definitely something that if people believe it's serious, it could shock the market. I mean, it's one of those things where if you heard, Iran is closing the Straits of Hormuz, even if it lasted like 5 minutes, it could. That's a one piece of news that could really send oil prices spiking. So what's interesting that we're seeing here is now the U.S. is basically signed an agreement with Oman to give its Navy access to ports right around there, and I think that's significant because it does kind of put U.S. presence much closer to any potential area that the Iranians might try to use to close the Straits of Hormuz, and I think should give more confidence to markets that if there ever was any kind of escalation where Iran ever did this, and like I said, I think that that's extremely, extremely unlikely, but you never know, that this makes it even easier for the U.S. to very quickly counter that. And I think that markets should understand now, the placement of these vessels and what that means for the geostrategic, implications for the oil market.
Yeah, and remind me here on the Strait of Hormuz, the fear really isn't obviously the Iranians are going to ship out, some battle cruisers and go to war. It's more that they may go out there and kind of form a blockade, and then you're kind of stuck. Do you sink them? If you sink them, I believe it's pretty shallow over there. It's kind of more of a tactical play. There's not really a kind of an ambush situation. It's not really a battle we're looking at. It's more of just a, if they wanted to, they could strategically place some ships, which could cause problems where maybe you have to put Navy SEALs out there to go overtake the ship. It's stuff like that you're kind of worried about with the Strait of Hormuz, correct?
I think so. I mean, if you actually look at what it's like traveling through there, it's incredibly narrow, and they can basically you can get like one ship going one way and one ship going the other. Mm-hmm. But the issue is that the Iranians actually control both sides of it. And I'm of course looking at my handy dandy map of the Middle East, which unfortunately I guess our listeners are not, but anyway, I'm looking at it. And so technically Iran can station troops on either side, and they have conducted military exercises where they, pretend to kind of cut it off. So I think that just having these U.S., if the U.S. being able to access these ports provides a measure of kind of stability, saying, look, even if Iran did something, the U.S. would so quickly be able to counter it that it wouldn't be that much of a problem. And we're also talking like different, from what I understand, the level of like, it's like a completely different level. Like Iran, can put troops there and they have artillery, but like the U.S. has got massive battleships. And so they'd be able to take that stuff out very, very quickly. So I don't really think we need to consider it as a serious threat, but I can see why the U.S. would want to have access to these ports. It's an extra level of security.
And looking this up real quick, it says, according to the EIA, in 2011, an average of 14 tankers per day passed out of the Persian Gulf through the strait, carrying 17 million barrels of crude oil. That was said to represent 35% of the world's seaborne oil shipment, or 20% of oil traded worldwide. Now, that's back in 2011. Obviously, some things have changed, but you can see, obviously, 20% worldwide. And 20% is a big enough number where you can see that, hey, that could really impact the market. But if you're in a huge supply glut, as we talked about before, when you got a lot of oil out there and there's this oil everywhere, stuff like this isn't really a concern. When we see draws like we've been seeing, all of a sudden it's like the headlines start to get a little bit more ominous. Okay, well, if this happens, and you can start to see the path to the price shooting upward. And I always find that interesting that when there's just build upon build on oil supply, it seems like there's no headline that's ever going to bring the oil down, oil price the supply down and the oil price back up. And then when you get close to maybe balancing out the market, it seems like all of a sudden all these headlines about what could happen to shoot it up to $1,000 a barrel reappear.
Yeah, exactly. And if they, we will see it in the market also because you'll get a headline from Bloomberg or Wall Street Journal. Iran threatens closure of Strait of Hormuz. Mm-hmm. And people will just read that headline and they'll be like, oh, that's a huge important waterway, price is going up. Even though, and the truth is that who's going to be most affected by closing the Strait of Hormuz? Okay, ain't going to affect the U.S. because we don't use that waterway to ship our oil. Okay, but it's going to affect Saudi Arabia, which ships a lot, but not all, because they do have pipelines that traverse the entire country, so they can ship out of the Red Sea. It would definitely disrupt oil shipments for some time because more of their oil comes out of the Persian Gulf or the Arabian Gulf. If we have any Saudi listeners, I know they like to say the Arabian Gulf. I'd say the Persian Gulf because that's what we say in the United States. But to be fair, it would impact Kuwait. It would impact Iraq a lot because they ship a lot of their oil out of there. They do also, they can ship out of Turkey, but a lot of their stuff from the south goes out there, and of course the UAE and Qatar. So and it would also affect the liquefied natural gas trade because Qatar ships are of liquefied natural gas are going out there too, and that would actually, I actually wonder if that would have a larger effect because Qatar has such a big share of the LNG, the global LNG market. If that would actually there would be a bigger effect on on some natural gas markets than there would be on the global oil market.
Maybe so. Okay, let's turn now to The Hill. Oil execs boast of unprecedented access to Trump officials, according to a report. A newly reported recording. So we got a recording here, Ellen. Goes on to talk about that they have access to former Secretary Ryan Zinke and he was of Interior and Scott Pruitt of the EPA. I found this interesting because, okay, so it's one of those things where what exactly are the oil executives needing to get to the administration for? Because I can understand if it was a heavily burdensome regulatory administration, but the Trump administration has tried to roll back legislation. So do you think this is more posturing, saying, yeah, we're able to roll back legislation, this has been good, or do you think maybe there's something more here with opening up federal lands? What's the angle here?
Yeah, I'm not really sure. I think the angle was, ooh, this is a, sexy headline. Of course, it came out at totally the wrong time because nobody is going to care about this today. Maybe on a different slow news day, but it's kind of interesting. But yeah, it's a good point. I mean, like what extra access are they looking for? I mean, they already, rolled back regulations. So what is it that what extra are they looking to get? I don't know. Maybe there is something extra that we don't know. I mean, it does say, we have unprecedented access to people that are in these positions who are trying to help us, which is great. And that what's also interesting is that it comes from the Independent Petroleum Association of America, which is a group of oil and gas producers. And this came from a June 2017 meeting. So maybe they didn't really have a sense of what was going to happen until that point in time. I'm not sure, I'm sure if any of these people wanted to meet with the secretary now, Bernhardt, I'm sure that he'd be more than happy to meet with them anyway. So I think this is like a mountain out of a molehill. Right. But I wonder if what's kind of interesting is I was thinking that they're talking about the Independent Petroleum Association. So it's who's in that group? Are those more of the smaller producers as opposed to the larger producers? Because one of the interesting things, at least that I always say when it comes to regulation, is that large companies like regulation because they usually have the resources to deal with these regulations that smaller companies don't. And so it cuts down on competition for them. So I actually wonder if this has more to do with that fact, with the fact that these are smaller companies than just oil companies in general.
Before you came on, Ellen, we had on Vincent DeVito, which was around between episode, at least if you look at the numbers, between episode 8 and 9. We had some unnumbered episodes in there. We went to a conference. It was the America First Energy Conference, and he was counselor to the Secretary of Energy, Vincent DeVito, and he was under Zinke, Ryan Zinke at the time. And so I'm looking up now, and he has left there. He now he works for Cox Oil, which is a privately held entity that owns and operates assets in the Gulf of New Mexico. I'm not exactly sure on this, but didn't the Department of Interior release a bunch of assets in the Gulf of Mexico?
Yeah.
I mean, I can't. It sounds like that's familiar from somewhere.
You're saying that a government bureaucrat acted on information or did something that could possibly benefit them now that they're out of government service? Oh my God.
I don't want to be
I've
like
never
Michael
heard of
Avenatti.
such a thing.
No, I'm not saying that. I don't want to be Michael Avenatti. So no, I'm not saying that at all. I'm saying thank you, Vincent, for coming on the podcast. We really appreciate your time that day.
Come back. We'd love to talk to you about what's going on in the Gulf of Mexico.
Yeah, those blocks. How did they land in that hand? Anyways, so moving on. No, I just found that was interesting. But yeah, I don't know. I wondered about that as well. It's an interesting headline, but what's really the crux of the issue here? Maybe they're just Ellen, they're saying, hey, tell Trump to quit bragging about low oil prices,
that if they could get through to him on that would be very interesting.
Yeah, well, I was reading a report from Reuters this morning talking about the oil prices, and it's kind of a mixed bag right now on what the sentiment is in the market. It's just so funny how things change from month to month and week to week and day to day almost. It's like, a few months ago, it's like, oh no, prices are going to fall. Then now it's like, it feels like, and I was out of town last week, so I missed Lord knows what, but it feels like right now it's people are saying, you know what, the global economy is going to crash, but oil prices could stay high. And so there's always something to be juggled, it feels like, when it comes to that stuff.
Oh boy. Yeah, I really think it could go either way at this point. In fact, I wrote last week my column for investing.com was basically I made one argument for why oil prices would go higher and one for why, they would go lower. And I just said, you know what? You decide, because it seems like it could go either way here. And good arguments for each.
Okay, as promised, we have on Gene Epstein, who I've heard on, you should check him out on Tom Wood Show, on Bob Murphy's show, a lot of good stuff. And Ellen, as we mentioned a few weeks ago, we're talking about the insider trading issue with Saudi Arabia, and Saudi Arabia, and the emphasis of that. So we're going to get to him in a minute. Right now, he is the founder and director of the Soho Forum, which you can find at thesohoforum.org. We will link to that in the show notes. I haven't been to one, Gene, but I've heard some of your debaters and some of the topics.
Where are you based? Where do you live?
I live in Texas.
Okay, it's a bit of a schlep to downtown Manhattan, but look, even a Texan likes to spend a little bit of time in Manhattan, right? So come visit. We get a lot of out-of-towners who are passing through. There must be something, it must be other things you can do in Manhattan, and you'll take in a Soho Forum debate and take in a Broadway show, do whatever else, yeah.
Well, next time I'm up in that area, I will definitely try to work around it because I want to see one. Before we go, we will tease the Contra Cruise debate between Bob Murphy, who's been on the show before, and Tom Woods, because I know that should be something of interest.
Oh, that's the Soho Forum takes to the high seas. Absolutely, yeah.
That's right. Okay, Gene, so before we get into the Aramco stuff, kind of give us some quick background. You worked on Wall Street, you worked for Barron's. Kind of walk us through your career, and you were telling us offline what your interest was in commodities, so you kind of set the table for where we're going to go here in a minute.
Well, I've bounced around in my career is the long and short of it. I started out, I'll pick up my career when I was in graduate school, teaching college, teaching economics. I dropped out of that. I didn't really want to teach recalcitrant undergraduates. And so I just drifted. And I got a job with the city, and then I got a job as a director of commodity research with a national firm called Reynolds Securities, which has since been gobbled up. I didn't really know much about commodities, but I learned on the job directing others as well. And I wrote a book about commodities. After I left that, then I drifted, and I got a job as planner and then senior economist at the New York Stock Exchange. In fact, I proposed and helped plan the aborted New York Futures Exchange. So I learned a lot about that. Then I drifted, got a job as commodities editor with Barron's Financial Weekly. That's the position that they had open, and wrote about commodities. And then they created a job for me as economics editor, and I did that for 25 years. And now now I'm on the ash heap, and I'm having a good time freelancing articles out of an office and running a monthly debate series called the Soho Forum. So I've had the benefit of a lot of different experiences. And for Barron's, I actually did some pretty good forecasting, calling the top of the oil market when it was over $100 a barrel, and predicting that it would go below $30, and I was right. And so I've been following commodities in the oil market, although I'm not actually up to date on precisely what's going on with oil right now. But I have a lot of, and I'm also book review editor at Barron's, and so I got a broad range of understanding about such things as insider trading, which I gather is one of the things you want to talk about this afternoon.
Yeah, so that's great. Let's just start here with one of the things Ellen and I always joke about is, we were talking about it a minute ago, the news and how the news seems to drive trading on some level. And even though the story really isn't necessary to influence trading, it seems that traders use that. And I always use the example, it was last year sometime before Trump met with North Korea. It was like oil prices spike on fear of Trump meeting with North Korea. And it's like, what does that have to do with the price of oil? Being someone who's dealt with this for so long, how much is that fact, how much is that fiction that the news from certain websites at least is generated really to kind of see the price fluctuate? Or is that just maybe my perception or our perception, or what's the balance there, you would say?
Difficult to know, difficult to strike a balance. Certainly, my long-winded response to that is that on the one hand, certainly one of the factors is that if you have the assignment on the Wall Street Journal or any news source to account for a price move, then you hate to say, well, it was just technical factors or the market spiked, who the heck knows why. It's hard to last in your job if you keep saying that. And so people often look for reasons for the market to react, market move to have happened, when not infrequently it's inexplicable. We don't quite know what exactly was happening behind the scenes because there's so many hundreds of different players in the market that it's difficult to tell and to account for every market move. And so to some degree, that is exaggerated, that the market necessarily spiked on, Trump having a meeting. That could just be a rationale that somebody on the desk made up in order to explain the move. On the other hand, I could certainly say from my own experience that as somebody whose job it was to cover the economic data, I certainly could see when, in particular, the monthly employment report, since it had a special cachet with the bond market and often with the stock market, was having an effect on the market. And for example, about 4 years ago by now, perhaps 5 years ago, there was a print which said that from the Bureau of Labor Statistics, which said that that employment was absolutely flat in a particular month. I think it was September. That in the month of September, there was no increase at all in employment from August. And the headline ran, employment grounds to a halt, no increase at all, and the markets got spooked. There was a decline in the stock market on the day once that announcement came out. And my point is that the markets overreact to economic data. About a month or two later, that number was upwardly revised to a gain of about 110, 120,000 jobs, which was respectable enough. And so I do think that, to answer your question fully, the markets certainly do overreact to certain events that could be transitory, especially to economic data. I have found they tend to interpret the data as having the finality of a market close, and they don't recognize that the monthly data are only approximations at best. They're not infrequently revised, and the only way to make any sense of the data is to calculate a moving average and see, well, how is it moved a little bit? It adds a little bit to our knowledge, but not nearly as much as the markets think. And therefore, I do think that markets, because of course, obviously, if you've got your money on the market, I guess there's a tendency to be nervous. Markets do indeed at times overreact to events and overreact to data.
One quick follow-up on that is when we look at commodity markets especially, how much of the market fluctuation is coming from the real big traders versus how much of it is coming from maybe small independent traders or traders that you see on Twitter who are talking about the market moving? Is it really just a handful of big, large companies who are actually moving the market, or is it really spread out across the world, if you will?
The reason why, truth is that I'm just drawing. I'm taking a guess and answering that question. The reason why I tend to think that it's spread out is only because if you're big, then you're aware of that. If you're a big trader, you're aware of that. And certainly, I know in the stock market, you will be very sensitive to your ability to move the market when, for example, you buy. If you buy and the market moves up too much, then you're getting a worse and worse price as you buy. And so for that very reason, there's a real premium on the skill of buying and moving the market to a minimum, of moving into the market gradually, for example, rather than abruptly, because you're going to get a bad execution if you do so. And so for that reason, because I think that the big guys, the big traders in any market tend to want to be subtle about getting into a market, I think that probably does leave some room for the smaller traders in the aggregate to affect the market as well. Again, in short, if the big traders really are moving the market a lot when they do trade, then that's kind of a dumb way to trade, and they're not dumb. So I think that they try as best they can, and they have the skill to trade without moving the market excessively.
That's really, really interesting. And I actually wonder if when we often talk about when Mexico does its big oil hedges, and suddenly the market will jump and you're like, whoa, what's going on? What's going on? And someone will come on and say, it's just Mexico doing their regular thing. Is that maybe a good example of what you're describing?
Well, it does sound like a little bit of a joke. Oh, the Mexicans again. Well, I guess the interpretation there is that whoever trades for Mexico is doing a cruddy job of trading, because if Mexico's buying or Mexico's selling and the market's moving down on the sale or up on the buy or covering a sale, and the market's moving up or down, then whoever is servicing the Mexicans is not doing a very good job of it. But very possibly, I guess, if you do have to move a lot of volume, then it's difficult. But I do think that people are a little bit glib about that. I mean, before you jump to conclusions and say, oh, there's those dumb Mexicans again, you might want to ask yourself, maybe you're misinterpreting, and maybe the Mexicans aren't that dumb. So that's why, as I say, I'm skeptical of the idea that big guys move the market so quickly. On the other hand, I guess, of course, if there's a really abrupt event in the market that surprises everybody, then I guess everybody's got to pile on, even the big guys as well. But as I say, I'm a little skeptical of the glib interpretations, because people, reporters, journalists, others tend to fall back on the easy interpretations about why a market has moved. And ultimately, it might be a bit of a mystery as to why it moved to the extent that it did and who was behind it. Because in the very act of trading, people do not want to be transparent. I mean, that's a key point about the market. You don't want to be transparent, because to the extent that you are transparent, by and large, you're acting against your own interest in getting a good execution in the market.
Kind of parlaying on that to another topic that we discussed a while back, but I think we wanted a more expert opinion on this. And one of those things was the Saudi Aramco, the national oil company of Saudi Arabia, which I've done a lot of research about, recently announced that they are going to be or already are in the process of building a big oil trading unit in London, and they want to become one of the top 3 oil traders in the world. Now, I've long said that I kind of always assumed that all the big OPEC players were trading oil based on their information and things like that. But now at least Aramco is coming out and saying, we're doing this and we're doing it in a big way. And I've always wondered if perhaps they really would have an incredible edge there, because they've got former Aramco employees in OPEC meetings, sitting there, with the Saudi energy minister, and it would be fairly easy for one of them to just, send a WhatsApp note to their buddy in the trading division in London saying, "Hey, the meeting's going this way," and before you know it, Aramco is trading on it before any of the other big companies have any idea of what they've decided, and it seemed to me like a bit of insider trading. And I was wondering what kind of your take on this type of thing in commodities trading in general is.
Well, in general, I don't. I'm going to answer a question that you haven't totally put to me, but because the first you've gone more deeply into the issue than anybody. The first question I'm usually asked is, should insider trading be illegal? And my answer is absolutely not, because insider trading is basically a victimless crime. If you buy and put buying pressure on the market because you have certain knowledge, then you're benefiting as many traders as you're hurting. I could elaborate on that, but I think it's fairly evident that if you're buying and your buying pressure bids up the market because of information that hasn't yet come out, you bid up the price, and that means that you're helping others who are selling at that moment. The widows and orphans who might be selling are getting a better price because of your buying, because the information has come out and is reflected in the market. And so I don't think that there's shouldn't be anything illegal about it. And similarly, of course, if you're selling, insider traders, of course, have been arrested for selling in advance or buying in advance. But clearly, they are helping others who, at the same time, you're selling and somebody else is buying. That person gets a better price because of your selling pressure. But to address your question more directly and more maybe a little bit abstractly is that to the extent that you're talking about big players having a lot of information, and of course you're saying at the extreme, my God, they're at the OPEC meeting, and that's a very big piece of the market, and they know what's coming down at the OPEC meeting before the announcement comes out. I don't think there's anything wrong with that, and I imagine that what would happen, what should happen, of course, is that astute traders who are not at the OPEC meeting or not trading with Aramco are going to know that whenever there is an OPEC meeting, they may want to stay out of the market. They may feel that the odds are way too much against them in order to trade the market because of the advantage of Aramco. And so really all I'm saying is that to pull back a little bit further, in any market, there are players with informational advantages. I know a guy who takes what's called the Commitments of Traders report from the Commodity Futures Trading Commission. Commitments of Traders, which tells you what the position of the large hedgers is in any particular market from month to month. And he's found it to be useful as insider information, meaning then that the large hedgers in any market, including oil, have privileged information, and they are often putting their money at risk, contrary to what's commonly believed. Hedgers do hedge to diminish risk, but they often take some risks because they have knowledge. And so if you see where the commitments of traders are of the large hedging of the large commercials, then if you trade with them, then you may have an advantage. So you're taking advantage to some degree of that insider information. So all I'm really getting at is that in any market, caveat emptor, let the buyer beware. In any market, you should know who has the advantage at any time. You should know how to get your edge, if you possibly can get one. But to target your particular question, all that would really say is that if an OPEC meeting is happening, and that is public knowledge, then you might want to be out of the market because or you might want to see if you can find some evidence about what Aramco is likely to do. But in any case, you want to take that into account in terms of your trading strategy. And so, but of course, at the extreme, if you want to say, let's imagine a situation in which the OPEC is always in session, or they're always talking to each other. Nobody's going to want to be in a market where it becomes common knowledge that one player or a couple of players have all the advantages. That's the other problem that you create. If you have a market dominated by, let's say, a couple of insider traders who always have the inside information and can always profit from the market in ways that you cannot, then there are no odds that you can make any money, and so you won't even be in the market if that's going to happen. So again, the market should presumably take care of that on its own.
Now that is actually, I actually now wonder if that may be one of Aramco's big motivations for becoming a huge a player in the oil market, because we know for a fact that the Saudis hate the ups and downs of the market. They hate all of the volatility, and they're constantly coming out and saying the speculators are ruining the market, and they're doing everything against our attempts to balance the market and have stable oil prices. So that could be a very interesting strategy, essentially dominate the market to the point where these what they refer to them as speculators, but they really can't have much influence because Aramco is so dominating the market.
Well, yeah, okay. Well, that's a fascinating inference to draw. I mean, maybe you know more about the oil market than I do at this point. I think though it's a common refrain to scapegoat the speculators for volatility or for big moves in the market. And while clearly the speculators do have a bit of a role in overstating tops and overstating bottoms in the market, there's little question that the market is moved by fundamentals. There's little question that the market is capable of moving, from from $147 a barrel down to lows of $27 a barrel within the space of what? It took about 3 years for it to happen. There's little question as well that the Saudis and OPEC in general do not completely control the market at all. And so I think that if they really think that they're going to stabilize the market in that way, I think that they are under a delusion. There are too many other players in the market at this point. As you know, obviously the biggest mover of the market in terms of for the fundamentals has been the U.S., has been the frackers of the U.S. who've turned the U.S. from a net importer of oil to, in the coming year, a net exporter of oil. And so that's been the primary factor, and that's happened independent of OPEC. So I think it's a dream on their part to have that much control. Not to mention the fact that, as you know as well, sometimes OPEC is coordinated, sometimes they're not. It's still a dispersed enough market so that it's very difficult for any one trader, as large as Aramco is, or any group of traders, to have that much control over the market. The inherent volatility of the oil market is just based upon the inelasticities. That if there's a lot of oil in the market, the term inelastic is a bit abstract. All it really means is that if there's a lot of oil in the market is very volatile on the downside, and if there's a scarce amount of oil, if something happens so that there's not enough oil to meet demand, then the price will jump because of what's called the inelasticities of demand. So that inherently is the reason why commodity markets exist, because of those inelasticities. The market is going to be volatile no matter what the Saudis try to do.
So I know we're running close to our time here with you, Mr. Epstein. So one quick question, just general, because I have heard you talk about the economy generally, and obviously you studied the stock market. Ellen and I were talking a minute ago about the headlines, and the headlines are economic woes ahead, maybe globally, maybe U.S. You might see a recession, you might see a downturn.
Yeah.
Just I know you kind of preface this by saying, hey, I don't follow the oil market as I used to, but just generally, for the listeners, how should they think about the indicators for economic a recession or a downturn in the economy or a global downturn? What are some of the things that you look for to see if we're going to go through some tough times in the broader economy, either in the U.S. or abroad?
Uh-huh. Well, I mean, I could mention that that oil spikes, sustained oil spikes, have been associated. Well, they are called oil shocks. They have at times been associated with downturns. I don't anticipate that happening now, and so I don't think the next recession is going to be oil related. And all that, of course, really happens is that whenever there is a recession, there is a slow. It does affect the price of oil. At the moment, I'm most impressed and of course I'm impressed by so many others because it's been written about and commented about what's the inversion, what's called the yield curve, the fact that the 3-month interest rate moved above the 10-month. The 10-year, sorry. The 3-month interest rate moved above the 10-year interest rate. And so that's called an inverted yield curve. The long-term, the 10-year interest rate is normally, in a normal yield curve, the 10-year interest rate should be higher, is normally higher than 3-month. And when that inversion occurs, it's actually one of the most reliable signs of a recession. In so many other cases, we get what the economists like to call false positives. I call them false alarms. A bear market in the stock market, and it's an old quip of Paul Samuelson's, the economist. The stock market has predicted nine out of the last 4 recessions. In other words, there's always a decline in the stock market before a recession. However, there are many declines in the stock market that occur, and there's no recession that happens. So it turns out to be too many false alarms. But what's interesting about the inversion of the yield curve is that it has very, very few false alarms. And so I've been a little bit disturbed that that's begun to happen. And I do think it has to be sustained for a bit longer. And I historically, however, if there is an inversion of the yield curve, it sometimes takes a full year for a recession to occur after that inversion happens. But that's what I'm looking at the most concerned about. And I do think that it, along with others, it does indicate the likelihood that there will be at least a slowdown in economic growth globally, and as well as in the U.S., not necessarily a recession. But I mean, that's the best I can do at this point in terms of looking for the future. I do find that I want to see if the yield curve inversion continues, at least for another month or so. It seems to be coming in and out. I could interpret what it means. I mean, certainly, if you think about it, the idea that what is it really signaling? The idea that a short-term, a 3-month interest rate can be higher than a 10-year, I'm sorry, I keep saying, a 10-year interest rate, one would think would be a little bit disturbing, because that signals that there's not a whole lot of interest in 10-year commitments. That's one signal that it's giving. And then in addition, if the 3-month is higher than the 10-year, it creates financial issues for financial companies that tend to borrow short and lend long. So that's disturbing. On the other hand, as I say, the returns aren't in. It's just that if you ask me what most impressed me right now about the outlook, clearly that's it. And of course, you could read about it from others as well. The inversion of the yield curve has been disturbing a lot of people.
We mentioned the Soho Forum briefly as we started this. Go ahead and talk about the Soho Forum. You'll have a debate, I believe, Monday, the April 15th is the next one, if I'm correct, on the website, the sohoforum.org. We'll link to that. And then you also, Bob Murphy was a guest on the show a month or two ago, and he has a debate with Tom Woods on the Contra cruise that you will be a part of in June, I believe that is. So why don't you kind of walk through a little bit more about the Soho Forum and talk about the Contra cruise.
Well, actually, the debate, the Soho Forum takes to the seas on the Contra cruise. I'll be moderating the debate. That will actually be July 5th. When the Contra cruise takes off from Seattle to Alaska, and I'm going to be there. Looking forward to it with Bob Murphy and with Tom Woods. That's July 5th, and invite everybody to come along on the Contra cruise. And if you just go into Contra cruise something or other, you can get access to it. My own Soho Forum is going to have a debate on climate change on April 15th with two pretty highly qualified people clashing on the issue of climate change. And that, too, of course, is there we have a very dire outlook on the part of many. And the person who's going to defend the resolution is going to argue that the idea of carbon dioxide being a threat to dangerous global warming has been much exaggerated. And there will be another person, a guy named Jeffrey Bennett, defending the argument that climate change is indeed a source of great concern. That's at thesohoforum.org, April 15th in downtown Manhattan, and I invite you all to come.
Okay, great. Thank you so much, Mr. Epstein, for coming on. We will link to the sohoforum.org in the show notes if you're in that area. We do have listeners from that area because we've gotten comments and questions. So if you're there, go by and check out the Soho Forum. As I said, I haven't been personally, but I've heard some of the speakers talk about it. It seems like it's a real fun event. And as we were talking offline, it's next. I've never been to New York, so I can't say next time. But the first time I get to New York, I will try to book it around this.
Okay, well, gee, you got to come to New York for at least once, before
at least once.
once the next year or so. Make a resolution about it.
Okay, there we go. Okay, Mr. Epstein, thank you so much for your time today, and hopefully get you on again in the future. This was a fascinating discussion.
Thank you so much.
Bye-bye.
Bye.
Well, thanks again to Gene Epstein. And be sure, if you are in New York, to check out the Soho Forum. Looking on the website, it looks like they have one debate about the 15th, 13th, 17th, somewhere middle of the month every month at the sohoforum.org. Ellen, I enjoyed the discussion with Gene, and I think, and we didn't have time to get into it, I wonder if he was getting at with the Aramco, if he was saying that if Aramco or if one player dominated the market so much, it would basically run the market out, and there wouldn't be ability for them to manipulate anymore. So they would be because all the other players would pull out, that there'd be nothing left to manipulate because it'd be you. I wonder if that was the extreme that he was alluding to there.
Yeah, well, that was my thought. And as soon as he said that, the thought never occurred to me. But if you look at all this rhetoric that comes out of Saudi Arabia, I mean, and I've had reporters even say, like, it's actually worse than what they report on. They only report a little bit of it. That how much they hate these so-called speculators who are driving the market and making it more volatile. That it almost makes me wonder if that's part of the reasoning behind this. If they think that they can eliminate some of the volatility by becoming a major player themselves. And that's something I didn't think of. And I don't think they'll ever be able to really run the oil market in any significant way, the way that they did in the 70s, like you said, because of all the different players in it now. But, there is something to be said for being a major player in it and pursuing their goals, not just through the supply and demand situation, but also as a trader on the markets. So
right. Well, and the thing I love about it is Gene pops on here, just got a little background, and we're like, okay, we talk about these three or four things, and he's just so full of knowledge that he's just like, yeah, I hadn't really studied this stuff, but he obviously has a lot of experience in that background. So the 10-year yield curve, Ellen, that's where he's looking. So we'll be following that. I don't know how to read those charts, but I'll be looking at them for sure.
Yeah, I think maybe we need a crash course in interest rates and yield curves. So
exactly. Well, thanks again, Gene, for coming on. We will link to all of his stuff in the show notes. Be sure to go check his Soho forum out and everything else he has going on. And Ellen, I guess that's it for this week. Where will you be?
I will be on investing.com on Thursday morning, and then I will be on Forbes sometime later. I'm not entirely sure. I'm waiting for something interesting to happen in oil to talk about it. But I did have a fun piece that I think some of the listeners might like last week, where I know that we generally tend to not be very positive when it comes to the EV market, but Aston Martin is coming out with a new electric vehicle that I think will be just perfect for its new owner, James Bond. So I'll link to that, and you can see if maybe it's right for you too. This is the great plot twist. They have the big car race, and Bond's car dies, and he gets caught by the bad guys because he didn't charge the battery
charge it properly.
Oh yeah. Hey, it's a whole new issue.
Okay, Texas Oil and Gas Podcast and Oil and Gas Contractors Connect for me. I will be, I believe, next week, barring Baby Piper's early arrival, which is not scheduled, but being that she was being a little difficult this morning and wouldn't flip, she's shown her stubbornness, so I can't say for sure, but I will be, let's see here, I will be at the Texas Alliance of Energy Producers Conference next week in Irving, Texas. So if you are out and about and you are at that, hit me up. We'll be promoting that on the Texas Oil and Gas Podcast as well. Ellen, anything else before we get out of here? Oh gosh. I will try to find this and retweet this, but I maybe already did. Did you see the Lakers' one shining moment?
Yes, I did.
As a Celtics fan, I had to get that in there. A little shot fired. Their one shining moment for missing the playoffs, and so it was glorious. It was glorious. So, all right, to the listeners, thank you so much, and we will talk to you next week.
Bye-bye.